Hello, hello, and welcome to the first quarter 2026 review and market outlook. My name is Austin Fitch, and we are Horizon Investments. I'm joined today by our Chief Investment Officer, Scott Ladner. Excited to have him with us and really excited to get into the conversation. For those of you new to this webinar, we do these each and every quarter to walk through what we're seeing here at Horizon, talk through maybe some of the things that we've seen in the previous quarter, but also focus on what our outlook is going forward and how that affects any of the portfolios that we're managing and strategies and products that we have here at Horizon. So we'll get into it and really dive in. I will say, don't hesitate to ask questions. You have that functionality there in the webinar feature. So please drop those in. If we don't get a chance to answer those questions today, we will make sure that we have somebody get back to you after this webinar so that we can reach out and continue the conversation. Really excited to have you here, though, and we will dive in. And I will say, Scott, there were a number of things that, as we were looking into what we thought the first quarter of 2026 was going to look like, we probably didn't have all of these items on our bingo card. There were so many things going on in the first quarter, and that kind of paints a pretty crazy picture at times. But I think the goal of today is to try and really kind of demystify some of those conversations and really get into the weeds on a few different data points. And I say data specifically because we will be using data on a number of these slides to really focus on, hey, here's what the market's telling us. So this isn't necessarily how Scott feels or how Austin feels on any given day or time. We really want to look at the data and see, hey, what is the market telling us? What's the economy telling us? And what should we do with that? So we'll get into that here in just a second. You can see the agenda on the screen. Again, we'll talk about labor markets. We'll get into private credit. So that's something we've kind of tiptoed around for a little while. For a couple quarters now, we're really going to hit it head on this quarter. Not surprisingly, we're going to talk about the war and the impacts there. And then we'll end with a few takeaways. And like I said earlier, we'll hopefully get to any questions that have maybe come through. But without any further ado, we will jump right into the conversation. And Scott, we'll set the stage with a conversation that we've had, seems like many quarters in a row now. And let's talk about the consumer, because the consumer is kind of the backbone of the economy. So walk us through this chart and maybe help us set the stage for what we're going to get into today.
Yeah. Hey, Austin, and hi, everybody. Look, one thing that we want to kind of start with, and we started with from this place a few times in these webinars, is understanding, like where are we coming from? Like what is the starting place for some of these things? Because we need to understand not only sort of rates of change about some of these variables that we're going to be talking about, but also just where are we actually starting from? Like the level also matters in some of this stuff. And as some of you are probably aware, the U.S. consumer, since the great financial crisis just scared the bazookies out of them in 2008, have been deleveraging really quickly for almost 20 years now. And people kind of thought that COVID may be a turn on sort of the leveraging system for the consumer, and it hasn't been. This is showing across every single income bracket that you can look at. The U.S. consumer continues to delever and continues to get, frankly, healthier from a balance sheet standpoint, and that's a helpful starting place when you're talking about some of the challenges that we're going to talk about with respect to the war and what that's doing to prices in the economy. So we just want to kind of start out by saying, listen, and we're going to show a few different ways to examine this, but leverage wise and balance sheet wise, the U.S. consumer and corporations actually in a pretty good spot.
No, that's a great point, Scott. And like I said, we've hit this a few quarters now in terms of talking about consumer health. Really another one that kind of builds on that, and we've gotten this question a lot, is, okay, but wages, right? Inflation has been crippling for some folks, and shouldn't that be a problem as you start to think about folks, maybe their wages aren't keeping up with that? And I think this is one where the data really just tells you something different. If we look at this chart, in terms of what it's telling us, the blue line is total compensation. The yellow line is, personal consumption expenditures, PCE. Think of that as a measure of inflation. And you can see it dating back to really the 2020 time period to where it sits today, pretty consistently outpacing inflation, which, Scott, tell me if I'm wrong, but I think that means the consumer, in theory, should be in a better place if we actually think about this inflationary scenario.
And look, you can't delever if you're not making more money than inflation. You know, like you have to have some extra money to continue to delever, to continue to pay down debt, to continue to pay down bills. And this, this for the economy overall. And we are going to talk about this, the K idea and like different income quartiles, things like this in a minute. But overall for the U.S. economy, like people are making, they got wages above inflation, and I don't care if you could look at CPI, you could look at true inflation, you could make the yellow line any sort of measure of inflation you want to. It all tells the same story. We use PCE because that's what the Fed uses. I think it's the most consistent thing that we could use. But they all, like, irrespective of the sort of definition of inflation you might want to use, like this story remains the same.
No, that's a good point, Scott. Another thing that we've heard, right, is okay, they may be making more money, but folks are charging money left and right on credit cards, right? We've seen a dramatic impact on delinquency rates and credit card usage. And again, this is just another one where we would say, hey, let's make sure we're actually looking into the data and what that's telling us. And this is literally just a chart of delinquency rates on credit cards. And while it is true that delinquency rates today are higher than they were coming out of COVID, look at where they sit relative to history. This chart goes all the way back to the early 90s. Scott, I think this is a point where the absolute level is probably maybe even more important than the relative level. Is that a good way to think about it?
Yeah, absolutely. And the credit card delinquencies are really going to show up first in terms of like the stress for the low end consumer. And so, we weren't, look, we were paying attention to this obviously in 2023 and coming in 24. It looked like it was hooking up, and it was, if that line continued like it was from 21 to 23, continued upwards, like that would get our attention, guys. But it didn't. It hooked back down. We're kind of settling in this 3% range. And I'll tell you, if you look inside the credit card data, if you look at like JP Morgan's proprietary credit card data, for instance, what the delinquency rates they're showing across the board are just like really, really healthy. I mean, like we're just not looking at a stressed consumer, somebody that is like, putting everything on the card and like paying minimum payments every month. Like it's just not happening right now. And so, just wanted to dispel a couple of these myths.
Nope. I think that's a great point. And Scott, you mentioned the consumers is not stressed in our first trading places reference of the day. Walk us through this slide and what we're seeing in terms of maybe just money that folks have available.
Yeah, look, they are people overall are feeling pretty flush, and that's why I thought of the Mortimer and his brother there. But they are they feel pretty rich, and if you just look at the and look, I know they're not answering surveys like they feel they're rich, and they are, you're all advisors, and you talk to clients, and people feel kind of down the dumps. But the data are pretty clear on some of this stuff. Like people are still generally pretty flush. Look at checking accounts, look at savings accounts, look at money market accounts. Like this is just sources of cash for people to use to pay bills and buy things and whatnot. Like just not really showing much of a sign anywhere that we are doing anything other than like staying pretty flush. And obviously savings accounts numbers are ticking down some, but that just means that people are probably not super excited about getting 2% on their savings account versus 5% they were getting a couple of years ago, and just moving that money into checking accounts. That's what it looks like it's happening from the data. But either way, people are still pretty have a lot of liquidity sort of at their beck and call. And we go to the next slide, Austin. Like we're going to see this is generally the case for most income groups. Now, it's not all. Like here's where the K, here's where we see the K. So the chart on the left is basically this cash pile. What I'm calling the cash pile, which is what we just talked about. Basically like liquidity I can get to tomorrow. The checking account, savings account, money markets. And let's look at this for in inflation adjusted back to pre-COVID times. And look at different income, basically different income groups. And what we see, it's fairly obvious. Like, okay, so the bottom 20% in terms of income have less inflation-adjusted cash today than they did before the pandemic. So they are "quote unquote" worse off versus like in terms of like liquidity characteristics versus pre-COVID times. But everybody else is pretty significantly better off. And the sort of the tie-in to the economy. The thing you have to understand is like, okay, yes, this bottom 20% is worse off. Like they are worse off on an inflation-adjusted basis from their cash pile standpoint. Now, from a labor market standpoint, from a cash pile standpoint, but what do they spend? Like what's their actual impact on the economy? This is not like, don't take this as a moral statement or anything. Like this is just a economic sort of fact-finding mission. And the fact-finding mission states is that bottom 20% is responsible for about 4% of the spending. So they just don't. They're just not the spending engine of the economy. So if look, if from an economic standpoint, if you want one group to be quote unquote struggling, or you're not keeping up, it's the one that spends the least amount of money on the front. So like on a marginal basis, like they just are not mattering as much from an economic standpoint. And so like that's, again, just trying to paint this picture like, hey, listen, the bulk of the consumers are pretty good, and the bulk of the money spenders are really good in terms of like their liquidity position, their leverage position, and their income slash kind of wages position.
Scott, we talk about cash pile and the consumer health, but one question that we have got from folks is, okay, does this create maybe dry powder from a market standpoint? As if things turn around, if some of the headwinds abate, like does this create maybe an opportunity for additional investment that we haven't seen really flow into the market over the last few years? Like, is that something that we're looking at?
It is some. I mean, look, this is kind of the classic cash on the sidelines question, right? I mean, like, what kind of cash flow on the sidelines that could come in? Our data is showing like there's some, and certainly in the money market sense, there is some, but we have to take into account like there's an aging demographic. Those folks are going to generally hold a little more cash than than a 40-year-old typically would. Yeah. And so it gets a little squirrely to sort of decompose all of those data and figure out like how much cash is really on the sidelines. I can give you the. It looks like there is some, but not like an exorbitant amount of cash sort of sitting on the sidelines ready to come in.
Nope, that's a great point. All right, so if we talk about the consumer, I think we have to talk about labor markets and what we've seen there, Scott. And this chart really breaks down, kind of decomposes, if you will, like labor markets over the last, call it 5 years. And what you saw, right, is we had a really large kind of supply cushion built in that, there was much more labor available than maybe was necessarily even demanded, call it 3 or 4 years ago. And Scott, we've seen a pretty significant trend where that cushion has kind of disappeared. But I do think it's important to point out that just because the cushion has disappeared doesn't necessarily mean that the labor market is weak. It's just that we don't have kind of that wiggle room anymore if we think about kind of private employment and what that means from a labor market standpoint. Is there anything else we should take from this chart in terms of kind of that labor supply cushion, or is there anything else that you're thinking about or our team's thinking about when it comes to labor markets as we talk about the supply demand dynamics?
Yeah, look, and the point I've been making about this, Austin, is, and to folks that when we're talking about this, is this makes things more fragile. So we don't have the sort of labor market cushion that we did coming into COVID or even shortly thereafter. This is obviously a direct result of immigration policies in the United States and over the last couple of years. And what I'll tell you is GDP growth for an economy. Again, guys, this is not a political statement. From an economic standpoint, GDP growth in the United States is a function of population growth / labor market growth and productivity. That's it. You have to get it from somewhere. It's either coming from productivity. I do more with less, or I do more with the same number of workers, or I grow the workforce and I grow the pie that way. Those are the only two ways that you grow the entire pie. And so if we have if we continue to have immigration policy that is not leading to a labor dynamic that is adding to robustness and basically adding workers to the system, that increases the fragility of that system. Period. And so what we hope we get is some immigration policies that are that are sort of sensible with respect to growing the pie from an economic standpoint. And so again, the point here is the labor market is not weak right now. We're showing all this stuff. It's okay. But it is more fragile than it was a couple of years ago, and it's a large reason is because of this sort of the lack of labor supply that we're getting right now.
Yep. No, that's a great point, Scott. And you mentioned productivity, and I think that dovetails into some of the AI conversation that I feel like we've had at this point for multiple years, 10 plus quarters as we're talking about these quarterly webinars. But I think what we're talking about from a productivity standpoint and a labor market kind of displacement standpoint, we're not quite seeing that on the AI side of things. Not that you're not getting adoption, but you're not getting the adoption necessarily to really disrupt labor markets as of yet. Am I reading that right? Is that what this chart is telling us?
Yeah, 100%. I mean, the solid lines down there where you're saying I'm using Gen AI to do work, like a lot of work on a pretty regular basis. You want to see those lines kind of J curving up. They're just moving sharply up. And we're not seeing that right now. People are sort of still in the experimentation phase. Companies are still in the experimentation phase. People are trying to figure out how to use this stuff. And so, as of right now, like we are just not seeing any evidence or data that show us that AI is displacing workers writ large. Now, that doesn't mean that we're not going to, and it doesn't mean that we're not going to see a difference in a sort of change in the composition of what type of labor and what type of jobs there are. But as of right now, like this is just not, it's not a fear that we can realize at all.
And to be clear, Scott, that's not to say that we're not seeing, like we are seeing productivity gains thanks to AI. We're just not seeing it displace workers. Is that a fair way to put it?
Again, yeah, like the labor market is best characterized as this low hire, low fire sort of dynamic, and that is companies and workers both sort of sets of people part of the labor market are experimenting. Like we're trying to, including us at Horizon, like we're all trying to figure out how to use this stuff best. And whether you use it is not a question. Like yes, of course you have to. Like you either use it or you become boarders. So like yes, we are using it. We will continue to use it. We'll continue to experiment. But we're just like everybody else in terms of like figuring out like how are we actually going to do this? What tools are we going to use? Like what jobs? Not necessarily what jobs can it displace, but what kind of tasks can it take over? So our folks can do other more higher value added types of activities. That's the situation everybody's in right now, and I think that's why we're not seeing sort of labor market disruption at much of a large scale at all. And with this incredible technology boom that we're just kind of starting to see.
Yep. No, that's a great point. And we talk about kind of displacement, and I feel like we've heard this anecdotally, but I don't feel like the data is there to necessarily support it. Is okay, but it's really hard for my college age kid who's looking to get a job that he's been fully displaced or she's been AI'd out of a job. The data's not quite there yet, and really not given any signs of that phenomenon happening. So Scott, maybe walk us through this chart and why it's important, probably more than anything.
Yeah, I mean, look, you just look at the unemployment rate for young people. That's what this is, right?
Yeah.
I mean, young people versus like the entirety of the labor market, which is age 16 plus years old. Like unemployment for the kind of the college age graduate people, the 24-year-olds, is actually a little bit lower than the overall unemployment rate right now. It is again, like this is kind of like a story in search of facts, and like the story being AI is going to take all the jobs, especially with the young kids, and the facts aren't there just yet. Again, like we'll see. We're going to keep watching this stuff, but let's just recognize reality for what it is at the current day.
Yep. No, that's a good point, Scott. All right. So last couple slides as we're talking about labor markets and what that means for kind of the consumer and the economy. One thing it has done, and I think we've seen this, is it has make it easier to start new businesses. We'll look at some data here in just a second. But you talk about kind of those new folks entering the labor market. I think it's also created an interesting dynamic as you start to think about what the market's going to value, or maybe even starting to value right now in terms of skill sets. So let's walk through that for folks, because I do think this is super interesting.
Yeah, I think this is awesome, and this leads into the chart that we're going to close the section with on the next one. But the chart on the left, guys, like this is the part that I think people get kind of freaked out about the labor market impact of AI, and like we're gonna have to have universal income and all this stuff because nobody's going to work anymore. Well, that's the biggest load of baloney I've ever heard about. Look, it's so easy to start a business right now. Like how much easier is it to actually create something from scratch? I guarantee told you the next Amazon has already been founded, or it's going to be founded in the next like 3 to 6 months. Like there is the next huge important company is going to be founded because of AI is making it so easy to build to do some of this work that was otherwise prohibitively expensive or time consuming, or like you didn't have the skills to do it. And now, like if you got a great idea, that making that idea into action is there's never been an easier time. And like if there's one thing that I'll bet on, it is the ingenuity and sort of the work hardness of the American workforce. Like people figure things out, and people like to start businesses, and people like to take risks, and like that's why all the big kind of exciting companies come from the United States. They don't come from other places because we have an entrepreneurial spirit here, and the AI is going to just turbocharge the ability for people to actually make good on that and actually make a reality out of an idea. And it's going to found companies that we've never even heard of, and there's going to be some important stuff coming in 5 or 10 years, and it's all getting founded nowish. And it's like the least reported story out there, and it's the most underreported fear about the labor market. I just think people aren't looking at the other side of the coin. The other side of that coin is incredible, and it's going to be the business formation that we're going to get out of this.
Scott, that's super helpful. And again, you mentioned we've got some data here in just a second, but I want to hit on the chart on the right. It will become relevant for me probably in the next 10 years, but Scott, probably it's becoming real relevant for you as you've got kids that are approaching the end of high school. But let's walk people through, because I think what you're seeing is not that the math and science side of things isn't important, but the social side of things is probably becoming the most important, which hasn't necessarily been the case if you look back over the last, 20, 30, 50 years, right?
Yeah, teach your kids to look somebody in the eye and shake a hand, and be able to carry a conversation without looking down at their phone. The social aspect of the employment side is going to be increasingly important, especially as AI makes being really good at math just less and less relevant to somebody. Like, I don't need to hire the smartest math person necessarily, but I do need to hire somebody that can talk to somebody.
Yeah.
And so, like, that having that social aspect, I think, is really going to be a pretty crazy change in like what employers are looking for when they're looking at candidates. I think it's super cool.
Yeah. All right. So we mentioned kind of the data. So guys, here's the one that we want to close with. This just looks at business formations over the last 20 years. And you can see, obviously, the data around COVID gets a little squirrely. So throwing that piece out, you've seen a jump just in the last 2.5, 3 years that speaks exactly to what Scott talked about just a second ago in terms of the AI nature and the AI tools that folks have available today really creates the ability for just about anybody to form a business in the matter of hours, as opposed to a matter of days, weeks, months, and sometimes years, right? So I think you're seeing that flow through in the data, and that is only a positive as you start to think about what the future of the economy, what the future of the market looks like. Now, don't get me wrong. There will be some that there'll be plenty that fail, right? And Scott, we'll talk about creative destruction here in just a second. But I think that the trend that we're seeing is only a good thing as we start to talk about what that kind of AI effect looks like for the markets. So I wanted to hit that before we shifted gears. But we will keep rolling, and we'll move into this private credit conversation because, as we all know, this is something that's been top of really everybody's mind for probably the last year at this point. And Scott, let's start with that creative destruction conversation because it's kind of a necessary evil as you start to talk about any sort of technological innovation and what you see in terms of market dynamics and market shifts. Walk us through kind of this slide and really what it means from an economy and a market standpoint.
Yeah, and I want to make certain that we're clear about why we're talking about private credit here, Austin. It's like it is not necessarily to opine, although like we certainly have ideas about whether we think private credit or something like private credit in an ETF or kind of liquid wrapper makes sense and kind of how one might use that. This isn't about that. We're not necessarily trying to like make a pitch one way or the other for something like a private credit ETF. That's not the point. The point that is the sort of the worry that I've been getting a lot of questions about, frankly, is like, hey, could private credit be like the next mortgage crisis? Like, if private credit blows up, can it take the economy down? Can it do whatever? It's like that's the angle that we're attacking this thing from. Is like trying to understand like how important is private credit to the system? If private credit were to quote unquote blow up, like what kind of impact might that have? Like that's the angle that we're trying to take. And so like to just want to make sure we're clear about sort of the point of this section. Now look, what also said the important words like the creative destruction part. Like the destruction is part of the creative process, and the software stocks have taken it on the chin, over the last several months because people are like, hey, listen, AI can write all the software. Like, why do I need to buy this software license from this company that's really expensive? And like, yeah, sure, that's true. It is going to make some of these software companies obviously obsolete, but it'll probably enhance the value of others. And the ones that figure out how to use technology versus the ones that are, just like, kind of first gen sort of software folks. So look, I mean, we're just making the point here. Like, yes, the software is taking it on the chin, and sort of like a first obvious target for Gen AI and for like kind of the coding capabilities of Gen AI. And like, let's sort of explore that. Like, what does that really mean?
No, I think that's a good point, Scott. And I think that dovetails into, so we talked about kind of the private credit market, right? If you start to look at some loans, especially, and we'll talk about the impact on the private side of things here in just a second. But if we just look at loans for software companies relative to the broader loan market, you can see the pressure that's really started to build in that software space just by looking at the yields on the two different data sets, right? And the good news is, right, the broader market really hasn't seen a significant jump, right? You've seen a slight increase in yields, which tells you that there's a little bit higher risk there, right? But software, as Scott, you pointed out, as a subset of that loan market, really is had a meaningful jump, right? And that's where folks start to get a little worried, a little bit concerned. And then the question is, and we kind of allude to it in the title, like, okay, is it spilling over, right? And as you look at the individual industry or sector, the question is, what does that look like for the rest of the market, right? And I think what you alluded to, Scott, in that, okay, AI may make software and software companies obsolete. There's maybe a little bit of truth to it, but the question is, what does that mean for the broader market? And I think having to look at the size of the market maybe puts it in perspective. And Scott, you talked about this idea that, is this another '08 scenario where something like private credit starts to take down the rest of the economy? We did this chart just to put it in perspective, right? So the yellow is mortgages as a share of private sector debt. Gray is private credit as a share of private sector debt. This paints the picture, I think, in a pretty meaningful way of just how important and how valuable the individual data points are. Because if you look at the mortgage market, right, that's over 50% of that private sector debt. You look at private credit, it's less than 5%. Scott, anything else that you would touch on as we start to look at this slide specifically?
Well, I mean, look, we put this on here to sort of try to make a point, like, there's all sorts of ways for a mortgage crisis to morph into an economic crisis. Like a mortgage debt is a meaningful part of the private sector debt, period, end of story, and it always has been, probably always will be. And so, you got a problem in the mortgage market. It's pretty easy to draw lines from something that's like half or 60% of the private debt outstanding in a country to like, hey, you got a problem in that market. Like, yeah, that can affect all sorts of things in ways that are not necessarily obvious, and everything else. But like, it's just it is not impossible for something like private credit at 3 or 4% of the sort of debt part of the economy to make a difference. It's just a lot harder, and so you got to be really precise about how would that transition mechanism work for something like private credit, because it is a small piece. It's not a meaningless piece, but it's a much smaller piece. So there's got to be a pretty precise way that that's something that's frankly that small can really impact the overall economy.
Well, and you said it, Scott, is it becomes a question of the transmission mechanism. If you're looking at how does something like private credit really flow into the broader market, and we've got some information, some data here that you can walk us through. Just in terms of like, okay, how could that actually get out into the market? It's a question of who owns it, right?
Who owns it, and do I have to sell it? So like transition mechanisms are always about like, hey, listen, they always come back to forced sales. Like they always come back to like in some manner, like I've got to sell this thing because otherwise I'm like my liquidity position is zero or I'm defunct or whatever. Like I got to sell the thing even at fire sale prices. So like in order to get in the position of I got to sell the thing, you got to figure out who holds the thing. And generally, like the folks, if you have kind of what's quote unquote strong hands holding the things or long-term institutional sort of holders of an asset, they don't usually have to sell it. Like they just don't. And so if you look at like pension funds and sovereign wealth funds and insurance companies, private, like the private funds and individuals are kind of like where you can get some of this, some of the selling pressure from. But for the vast bulk of like who holds the private credit stuff, it's people that just frankly don't have to sell. If they don't want to, they can just kind of hang out. And that's generally what we've been seeing. I mean, we've seen like a rush to the exits in some of these private credit vehicles by retail people and retail people like once removed, like kind of fund complexes. But we're not seeing it out of the pension funds. We're not seeing it out of the endowments. We're not seeing it generally out of family offices. Certainly not seeing it out of insurance companies. So you're talking about like somewhere in the order of like 20 to 25% of the sort of the private credit bulk of the private credit assets are subject to being fire sold. Yeah. Again, so like if we're just doing the math, like 4% of the credit market is private credit. and like quarter of that is held by people that might have to force sell at some point. You're talking about like 1% of the credit market being like in a forced sale type of holding position. If things really get nasty, it's man, that transition mechanism is pretty weak, man. Like there's just not a whole lot of ways for that to really ding the economy. And in a mean, like not zero impact, but like in a like great financial crisis or like a really, hey, we're really kind of going down the tubes sort of thing, spiraling sort of situation. Like right now, we just don't see it.
Yeah. I mean, I think we got to highlight the trading places reference number 2 here. I think you said it when we were talking about this. So, some rich people may lose some money, right? It's like that's kind of how we should think about it.
That's pretty much it. Yeah, like some rich folks going to lose some cash.
Yep.
There are it happens.
Yep. All right, so let's just pull on the string just a little bit more, though, right? Like, okay, so maybe it does come to an extent where you start to see a little bit of that transition mechanism. Like, what type of scenario analysis should we be looking at? And I think this chart does a pretty good job of like, okay, if we were to see private credit stress really become impactful, like what does that look like?
Yep. Yeah, and look, and I think so. Like, okay, so Scott's wrong. Scott, you're like I don't know what you're smoking, but like you got this entire thing wrong. Like private credit is going to be kind of ripple through. Like we're gonna have kind of like wider, large scale losses. Software is just the tip of the iceberg. It's gonna impact every industry, and maturity wall, like all the stuff, right? So all the bad stuff happens, and Scott's a moron, and he's just wrong about all this. So how does that actually kind of come into the economy? And so what I probably focus your attention on is that 5% default rate scenario. That's probably the most likely thing if Scott's really wrong. What's really going to happen? And what we're seeing is like a GDP impact of like 1 to 2/10 is probably the most likely outcome. If this thing becomes wider and more important and kind of does spiral a little bit, like that's the kind of impact that we're likely looking at from losses. But I'll caution you with this: it's really hard to have a credit cycle without an economic cycle. So in other words, like it's tough to get large scale credit losses without a recession. Period. It's just tough because companies can refinance. People like holders of debt don't want to default. The payers of debt don't want to default. They can restructure things a lot, and if the economic cycle is fine, like generally restructuring works, and you can kind of kick the can and kind of figure things out later, and hopefully kind of rework stuff like later on. But it's just like without a proper economic cycle, it's just really tough to have a credit cycle that morphs into something nasty. That's the sort of the root of a lot of my thoughts on this. And right now we're not seeing a big time recession risk. Like it could morph. We're talking about the war index. Like there's certainly scenarios where that could happen, but as of right now, guys, I just don't see the clean way for a private credit blow up, even if it were to become a little bit worse than I think it might be, to really have a meaningfully bad impact on the economy.
Yep. No, that's a good point, Scott. All right. You alluded to it, Scott, and we're over 30 minutes in. So anybody that logged into the webinar and thought we were going to hit the war within the first 30 seconds has probably been greatly disappointed. But we'll get into it. And I think the part of the reason, Scott, and maybe, tell me where I'm wrong, part of the reason that we think maybe it's not as important as maybe it was or would have been 20, 30, 40 years ago is that the U.S. is just a lot more insulated from energy shocks, oil price moves than we used to be. And I think these two charts kind of paint that picture.
Yeah, and exactly right. I mean, the left chart tries to paint it in terms of like the labor market because, as we've said a zillion times, like, in order to get the economy right, you got to get the labor market right. And so there's some impact there, but certainly not as much easier than it was. And, the right chart is just the energy intensity. So how much energy does it take to make $1 of GDP in the United States? And it's just a lot less. We know this, like, it's probably because things are much more efficient, partly because we've transitioned much more into services-based economy versus a manufacturing-based economy over the last 20, 30, 40 years. And so like you put all that stuff together and you come up with the conclusion, like it still matters. It's not a zero impact. Like there is an impact to $5 gas and everything else. It is just much less severe than it was in the past. It's not just true in the U.S. It's true globally.
Yeah. Well, and you kind of alluded to it there, Scott. I think the next chart does a good job of really highlighting, like this looks at energy intensity. So, how much energy does it take to generate a unit of GDP, right? Let's look at that for the world. And you can go back to the 1980s, and it's a very different picture than it is for 2025. So I think that's something that we all have to kind of reset in our brains, probably to some extent, because Scott, I think a lot of folks, and probably ourselves included, as we came into the industry, you know, 10, 15, 20 years ago, for those folks that have been in it longer, 30, 40 years ago, right? You've got this, mindset where, okay, hey, oil prices are extremely important, right, to XYZ across the economy. They're just not as important today as they used to be, right?
Yeah, look, that's just sort of a simple reality, but it does matter, and it's not just the energy price. It is like this does have to do with there are kind of second order effects towards towards changes, like very sharp, fast changes in energy prices. One of them is short-term impacts on inflation and kind of what that does to central bank outlooks, which we're going to get into next.
Yep. No, that's a good point. All right. So you talk about central bank impacts, and I think this is one that maybe surprised the heck out of me when we were looking at the data is, okay, what did we expect central banks to do? Let's call it beginning of this year, right? In terms of 2026 expectations. And then what do we expect them to do now, given what has happened from a war standpoint and a potential short-term inflationary spike? And Scott, it's been kind of night and day, like a 180-degree turn, however you want to describe it. Like, it's been a pretty big impact, hence the market reaction that we've seen, right?
Yeah, and look, like anytime you get central bank confusion or like the market not understanding or not being very certain about what a central bank may do, like it adds in volatility to the system and it adds in sort of uncertainty. It's just not good. Like it's a big old not good. And so like one of the things we got that we're trying to show here is like broadly across Europe, the gray bar is like, hey, listen, we weren't really expected to do anything in Europe. UK was expected to cut a couple times. But largely, like, we weren't expected to do anything, and US was expected to cut 2 or 3 times this year, and then post war, now all of a sudden Europe's got to hike rates a lot, and US is doesn't have the flexibility or freedom to cut rates at all anymore this year. We should understand that part of the reason for the discrepancy between the US and kind of and Europe kind of broadly is the mandate of the central bank. In the US we have dual mandate. We have labor market, maximum employment and price stability. So that labor market aspect towards the Fed's mandate is important, and it's part of the reason why we're not pricing hikes right now. In Europe they basically have a single mandate. It is just price. It's just headline CPI basically. And so if they have if they have meaningful inflation, which you will if you get a 40% shock in energy prices, and you're in energy, Europe is more energy intense than the U.S. is. Like that will increase the short term inflation. Like it just will, like mechanically. That's rather obvious. What you don't want to see, and what the market is pricing is those central banks having to hike into a supply driven like energy shock. That's a nasty thing to have to do. But they may do it because of the inflexibility of their mandates. But overall, like the big message here is we've introduced a lot of uncertainty into several what central banks were meant to do. Like after coming into this year, as you alluded to earlier, Austin, with like had a pretty good handle on what we thought was going to happen with central banks. There wasn't a whole lot of volatility or a whole lot of uncertainty with respect to what the globe thought about what all these different banks were going to be doing.
Well, and Scott, you said it, but I want to make sure we call it out. What we're looking at here is an environment where if oil prices and potential short-term inflation remains or spikes because of oil prices, you would potentially have specifically European central banks having to hike rates to offset inflationary risk in the face of an already weakening economy. Did I hear you right?
Yeah, it sounds about as smart as it is, but it is just the reality. Like,
right.
Yeah, if they would face, like, their playbook would be put us into recession.
Yeah,
It sounds like whatever. It's Europe.
All right. No, I just want to make sure we called that out for folks, because I think a lot of people think in a U.S. mindset where you've got the dual mandate Fed, right, where they can kind of lean on labor markets and not necessarily have to hike. But Europe is different, and we want to make sure we called that out. And Scott, you've alluded to volatility a number of times now. Let's highlight what we're seeing here in terms of why does volatility matter, and why is it a thing when you have central banks that maybe don't really have a great idea of what they're going to do?
Yeah, look, I don't want to belabor this point. It was just really like just trying to bring out and sort of quantify this idea that like every asset class is short interest rate volatility. So when interest rate volatility goes higher, it's like it impacts everything, and it impacts obviously impacts things like high yield and mortgages and things like that. But it, but it has a negative impact on stocks, has a negative impact on commodities. Kind of every asset class is short interest rate vol. And so like when you have central bank confusion that is a result of what's going on in Iran right now, that's part of the reason why we're having some of these sell off pressure. It's just part of the explanation. I just wanted to like think it's an interesting concept to have in the back of your head as an advisor that just know that pretty much every asset class is short interest rate vol. So if that goes up, like it puts a ceiling on stuff.
Yep, makes sense. All right, so we've talked about inflation a little bit in terms of kind of what that could look like, but I think it's important, Scott, that we highlight this is more of a short-dated expectation change than it is long-dated, and we've looked at this chart before. So this looks at 1 year, 2 year, and 3 years out in terms of expectations for inflation. So think of it as the yellow line is where we think inflation would be roughly at the end of 2026. The lighter blue line is where we think inflation would be at the end of 2027. The dark blue line is where we think inflation would be at the end of 2028, right? And I think what you see is, right, there's been a meaningful shift in inflation expectations for the end of 2026. And I say meaningful, right? You're going from 2.5 to 3.25, maybe 3.5%. So a full percentage point, right? Not necessarily anywhere near where we were in 2021, 2022. But you are seeing a meaningful move higher. But Scott, you're not seeing anything on 2 years, 3 years out. That essentially tells us that, hey, this is probably a shorter term phenomenon and not something that like is going to be a COVID like multi-year impact. Is that the right way to read it?
Look, that is what the market is saying right now. To be clear, like
Yes.
but I do want to say the words out loud. Like nobody really knows. Like we don't really like this is what the market's pricing right now, and I happen to agree with it, but that's fine.
Yep.
But nobody really knows if this thing goes on for 6 months, and you have $150 oil for 6 months. Like it's like we're not insulated from that. I mean, like we're just not like that. Like that probably is sort of a recession scenario. So like there are states of the world through this war where like these things can get pretty nasty, and it could get bad. I nor anybody else has any ability to forecast what is going to go on geopolitically with this. And anybody that tells you that they do, I think it's just kind of what I'll just leave it at that. But the other thing that's important to recognize out of this though is that there is kind of a self-correcting mechanism with respect to the inflationary impacts of an oil shock. Like obviously it's a short-term inflationary because just by definition like brings prices up. But then that does lead to some demand destruction. That does lead to sort of like overall slower growth, and that does tend to push down medium and longer term inflation expectations. That's part of the reason why you don't see much of a reaction from the longer dated stuff, is because there is kind of a self correcting mechanism within an energy shock that is true for all economies, not just the United States. But that is part of this. We don't want to get to the part where it is like we get the demand destruction and the slower growth and all that kind of stuff. But that card's in the deck.
No, I think that's a good point. All right. So we'll end. We've got, I don't know, 3 or 4 more slides, Scott. Let's talk about some of the tailwinds that we actually talked about last quarter. So end of 2025, heading into 2026, because a lot of these are still around. There's still things like should the war end at some point sooner rather than later? Like these all come back to the front of the picture. And we've talked about this time and time again. You're getting this kind of this stimulus effect from both the public and the private side of things as we start to think about the effect on the consumer and the effect on business. So walk us through these 2 charts.
Yeah, look, I mean, coming in, and we said it like right up front, Austin. I mean, like it doesn't matter like where the starting place is and kind of what you're coming from. And coming into this year, and like we were kind of telling a story about. We've got all this, there's a bunch of tailwinds at this economy, and a couple of those tailwinds are public sector stimulus with respect to tax policy, not only tax policy, but the refunds that we see coming through, and private sector stimulus, which with the AI build out essentially. And just putting things into perspective, like you kind of run out of ways to give context towards the sort of the capex spend that is going on in the United States and globally, frankly, with the capex build out, largely related to AI, but not exclusively related to AI. It's an important point. But just relating to the capex to defense spending and interest expense for the government, like it is larger than corporate income taxes. Being collected this year. I mean, it's a big number. It's a big dang number. And that it does act as a demand boost and as a productivity booster in the medium term. And it's a good thing. It's a big tailwind. It is coming up against some of these headwinds that we were talking about with respect to the war. But it is it's important to recognize those tailwinds are still there. And so that is a reasonable starting place.
Yep. No, that's a good point. The other one, and I know we talked about potential Fed activity a couple slides ago, but this is let's look at the effect of Fed activity that's already happened and what that typically means for kind of growth after that takes place. Scott, walk us through this chart.
Yeah, no, look, there's a lot going on in this chart. I apologize in advance, but I wanted to try to make a point that, so the line that, the dark line is Fed funds rates. The bars are nominal GDP growth. And that my kind of weird little kind of vertical lines and arrows are I'm trying to delineate the sort of the passage of time from when the Fed starts cutting to when you see a sort of an uptick in nominal GDP growth. And what does that time lag? Basically, what's the lag? So we're trying to measure, I'm trying to kind of visually show what the lag is between when the Fed starts cutting rates and when we see a pickup in growth and nominal GDP growth. And the point I'm trying to make here, going over 40 years or so, is we're looking at 1 to 2 years is generally what it takes for that lag kind of effect to end up happening. So from a tailwind standpoint, we know that we had Fed cuts starting about a year and a half ago, and now we're coming into this place now where just now those cuts are going to start kind of being that tailwind and sort of trying boosting nominal GDP growth, ceteris paribus, which it never is, but that's what we're starting from, and that is that's an important tailwind to recognize. And so we have tailwind from tailwind from fiscal stimulus on the private side, tailwind from fiscal stimulus on the public side, tailwind from monetary stimulus from rate cuts a year and a half ago that is just now kind of coming into the economic system, not the market system, the economic system of the United States. And look, we just need to recognize that these things are there. They will help. They may not be able to overcome everything, but it is a nice set of tailwinds to enter a conflict with.
So Scott, you mentioned all the other tailwinds, and we've talked about a lot of those in previous quarters, but the one that we've kind of hammered time and time again, and we touched a little bit on it earlier. I mean, the AI tailwind, we just want to make sure we hit it again, right? For a couple of different reasons: productivity gains, what you're seeing in terms of the impact. But Scott, remind everybody, what is the potential impact from productivity and profitability as we start to think about kind of that AI impact heading into back half of 26, but also 27, 28.
Yeah, look, so that this is important to understand. The reason why, big reason why the internet boom happened, it was because companies figured out how to become much more productive with this new sort of both PC technology that was sort of concurrent with it and the internet. It also led to a massive amount of business formation that was, when we talked about earlier as well, and that's a healthy dynamic. But the way that productivity enhances a corporate balance sheet, the way it actually impacts the stock price, and the reason why you get massive stock gains when you have productivity booms like this is because it operates through the margin channel. And the margin, and by operating through the margin channel, what I mean is it reduces costs and it increases revenue. Both of those things obviously are kind of what makes up margins. And if you're decreasing costs and you're increasing revenue, that is a margin expanding type of activity. And margin expansions are rewarded by the market in exponential fashion. It is the best thing you could possibly have happen to not only an economy but to a company to show consistent margin improvement. And so if we're talking about the thing that AI, how does AI actually get into a stock price? It is through this margin channel by decreasing costs and by increasing revenue. And so the thing on the right is from a Stanford study from a year or so ago, and it just was taking different companies, different parts of a company, and talking to them and saying, hey, listen, what is how much do you think AI is going to really impact you from a revenue standpoint and from a cost standpoint, and just listing sort of the different kind of cost centers or different parts of a company. And it's like, it's not everywhere for every single department, obviously, but these aren't small numbers that we're talking about. And these are, let's be clear, like these are people guessing to some extent about like what they think the impact's going to be. But there's no guess in my brain about like whether we're going to see some of these margin enhancing types of moves. I think we just started to see it, and it's the thing that the market is going to be looking for in terms of measuring the AI-ness of a company is like how are their margins doing? If you're not seeing margin improvement and you're saying that you're using AI, I don't believe you. And so like that, that is going to be the thing that I think the litmus test that folks are going to start looking for from some of these companies, like show me in the margins or show me a path towards margin expansion based on your use of this new technology. I think that's going to be sort of the litmus test for folks. But as you continue to see it, again, let me say it again, is an exponential impact on earnings, and it's an exponential impact on stock prices, not a linear one that you get from just plain old earnings growth. Like this is if you want one thing out of company, it is margin expansion, and this is the path towards it. Is the effective use of AI and the effective integration of AI into your business processes.
No, awesome, good stuff, Scott. Appreciate you kind of putting a bow on all that for us. Everybody, you can see the takeaways that we've got here on this slide. Hits on everything that we just talked about, from the consumer all the way down to the tailwinds at the bottom. We have had a couple questions I want to make sure we hit. And Scott, we spent a little bit of time on the war, obviously. Questions that we've gotten really center around, okay, what are the catalysts or signs that we should be looking at when it comes to the war? Is it as simple as, the Strait of Hormuz? Is it something else? Like what is our team looking for when it comes to the war to get a sense of direction on that front?
Yeah, I mean, look, you can't believe what they say. You got to look at what they do, on both sides. And so, yeah, I mean, like reading Twitter or reading X and trying to like form opinions about stuff is probably going to give you a massive headache. So yes, tracking ships through the Strait of Hormuz is going to be a big one. That obviously will impact oil price first. It's like I don't think we've got any special sauces to figuring this stuff out. There is, I will mention that there is some chatter about like ships basically lying about who they are to get through, and ships going dark through it. Some of that stuff's probably going on. Look, let me just be honest. Like I'm not a geopolitical expert with this stuff, and like we are more in read and react mode than we are in forecasting mode when it comes to things like this. And so we do have battle plans kind of ready. That's kind of a terrible choice of terms. Like we have portfolio plans ready for a couple of different outcomes. We've done a bunch of scenario analysis, but in terms of like figuring out, like if I see this, then we're gonna make these changes in a forecasting kind of way. I think that'd be a little bit foolhardy. Like we don't have any particular edge. I don't really think anybody has any particular edge in forecasting some of these events. You got to just be prepared, have your stuff ready, and be able to move quickly and efficiently in portfolios if you see some of this stuff start to change. But getting out ahead of it, I think, is kind of a fool's errand.
No, I think that's a great point. You kind of hit on the fact that we have portfolio options, and we've gotten a couple questions. Okay, if the war ends today, what happens from a market standpoint? What areas of the market scream? If the war continues on for 6 months to a year, how does that affect? I mean, just at a high level, Scott, kind of how's the team thinking about maybe those two extreme scenarios, and whether that changes portfolio positioning or not?
Yeah, it's a little bit of a continuum, Austin. So I think one of the things that I've been saying for a while here is that like one of the most important measures for this is time under conflict. Like how long does this go on? Like how long do we have elevated sort of uncertainty in oil prices or energy prices overall? And the reason for that is because like the longer it goes on, obviously the bigger a hit to nominal GDP, both with the U.S. and globally, you end up taking from the demand destruction side. A pretty easy sort of analysis. And so like if we have if we're in this for another 3 or 4 months, like you're going to get a nominal, like it's going to hit nominal GDP. Like there's no doubt. Like how bad it is will depend on a bunch of different factors that we don't have time to get into right now. But it does like kind of take one of the legs of the stool out in terms of like we thought we were going to come into this year and have really hot nominal GDP growth. And that's part of the reason why we had things like an equal weight positions and things that were more value oriented, more cyclically oriented, things that would really kind of positions that do quite well when you get nominal GDP growth are really kind of skyrocketing or sort of inflecting higher. Like that's things that are tied to economic growth essentially. As or if this thing goes on for a while, you gotta come off of some of that. You gotta move away from that and probably more towards good old fashioned U.S. large mega cap tech sorts of things because it's like if you want just the quick and dirty reason, like I can think of two no, I can't think of two less correlated assets, two less correlated things than the price of oil and Google's earnings. Google just don't care. It doesn't matter. They like frankly, they just like it's not terribly relevant. It's much less relevant, at least to them, than it is to many other firms. So I think the safety trade in this is, if this thing does drag out for months and months, is going to be the mega cap tech trade. Is going to be the back to sort of defensive safety, which is like as defined right now is going to be U.S. large cap growth. But it's not like a line of demarcation where like we got to switch here. It's kind of like the longer it goes, the more you probably want to be towards growth. The shorter it goes, the more you probably want to be towards that cyclically oriented sort of portfolio, and just sort of move as we get more information.
Yep. No, that's a great point. Last question. We've gotten some questions around risk mitigation and some of our protect strategies, just generally. Are they doing what we want them to do? We haven't seen a lot of de-risking in some of the strategies. Is that what we expect? So Scott, maybe talk just a little bit about that and the design of those strategies, in that they're not really made for the first leg down. They're not made for markets being down 2, 3, 5%, right? We typically are building strategies more focused on more catastrophic environments. Like the protect strategies themselves are built for a significant drawdown, not necessarily just normal market volatility. Is that how you think about it, or is there anything else you would add to that?
Yeah, I mean, look, like risk assist itself, the strategy is certainly more designed for that catastrophic type of outcome and kind of avoiding that. And so it intentionally ignores the first 5, 6, 7% of a drawdown. It just does nothing, and that is by design. But we have other protection strategies that use options or use stock selection strategies that are built for those types of drawdowns, and so like I would say that the combination of all of our sort of protect suite of things, everything's operating exactly as expected and sort of how we want it to. Those other types of techniques, risk mitigation techniques, have shown their value through this through the month of March. And risk is positioned exactly how it's meant to be right now. That part will be as designed.
Awesome. Good stuff. I would remind folks, for anybody that is wondering, at any given point in time, please don't hesitate to use our dashboard. So our technology tools, shout out to our technology team that's built some great tools here in-house when it comes to getting a sense of what to expect from certain portfolios. The tools on those on the dashboard do a great job of helping communicate both from us to the advisor, but also for the conversations from the advisor to the client in terms of expectations around, hey, market goes down 5% more, here's what to expect. Market goes up, here's what to expect. All of those data points are there, but we'd be happy to have conversations with you around how to use it, how to get the information out of it. And then also if you have questions about how things are working, happy to have those conversations, and we encourage folks to reach out. Really appreciate everybody taking the time today to spend just a little bit of time with Scott and myself. Excited as always to be able to walk through this content, but probably even more excited to continue the conversation as we get into the meat of the quarter. So please don't hesitate to reach out to either strategist, regional director, internal, you name it. We're happy to have the conversation, and we look forward to those conversations. So without any further ado, we will wrap up today, but we look forward to hearing from a lot of you and seeing many of you soon. Thanks so much.